'Cause it's all white noise swallowing me, taking your high horse and I'll be free. 'Cause it's all white noise swallowing me. Maybe we'll know why eventually. 'Cause it's all white noise swallowing me. Cause it's all white noise swallowing me, taking your high horse and I'll be free. 'Cause it's all white noise swallowing me. Maybe we'll know why eventually.
Cause I'm all over you. Are you all over me? True, it hurts when you see rainy days are too cheap to get to me. Cause I'm all over you. Are you all over me? True, it hurts when you see rainy days are too cheap to get to me. Are you all over me? And I have words for you some other time, in a different state of mind, catching up when you're behind. Cause I'm all over you. Are you all over me? True, it hurts when you see rainy days are too cheap to get to me. Cause I'm all over you. Are you all over me? True, it hurts when you see rainy days are too cheap to get to me. Are you all over me? Are you all over me?
I don't wanna know, no, 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 who's taking you home, 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 and loving
you so, 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 so. The way I used to love you, oh, don't wanna know, no, no, no. Who's taking you home, 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 and loving you so, 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 so. The way I used to love you, oh, don't wanna know. Wasted. And the more I drink, the more I think about you. Oh no, I can't take it. Baby, every place I go reminds me of you. What do you think of me? Of what we used to be? Is it better now that I'm not around? My friends are acting strange, they don't bring up your name. Are you happy now? Are you happy now? I don't wanna know, no, no, no. Who's taking you home, 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 home? I'm loving you so, 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 so. The way I used to love you, oh, don't wanna know, no, no, no. Who's taking you home, 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 home? I'm loving you so, 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 so. The way I used to love you, oh, don't wanna know. Someone new. I see, I don't believe it. Even in my head, you're still in my bed. Maybe I'm just a fool. Do you think of me? What we used to be? Is it better now that I'm not around? My friends are acting strange, they don't bring up your name. Are you happy now? Are you happy now? I don't wanna know, no, no, no. Who's taking you home, 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 home? I'm loving you so, 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 so. The way I used to love you, oh, I don't wanna know, no, no, no. Who's taking you home, 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 home? I'm loving you so, 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 so. The way I used to love you, oh, I don't wanna know. Oh, I don't wanna know. Taking you home, yeah. I don't wanna know, no, no, no. Who's taking you home, oh, oh, oh. Who's loving you so, 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 so. The way I used to love you,
All right, welcome to the Radius Plus Self-Storage Market Update live stream. Thank you for joining us. I'm James Gorter, and I'm gonna be walking you through the data and analysis today. As many of you know, we're tracking a ton of data across the entire country, everything from new deliveries to rental rates, and really the goal today is just to roll up that information, synthesize it for you, and really try and paint a picture of what's going on in the self-storage market, help you better understand the fundamentals, where we are in the cycle, so that you can make better decisions going forward. We're testing out a new medium here, YouTube Live. We would love for you guys to engage with us. You can drop questions right in the chat on the right-hand panel of the YouTube page. We'll also be fielding FaceTime calls, james@unionrealtime.com. Please try and engage with us. Additionally, we would love your feedback. We're always trying new things, trying to bring you better content. So if you could leave comments on the YouTube page, that would be really helpful, positive, negative, criticism otherwise. So with that, we'll dive right into it here. So just a quick overview. We're going to discuss where we are in the development cycle, sort of why we're in a development cycle, the implications of the development thus far, and then we will walk through our outlook for 2020 and beyond. All right, this first slide here is one of my favorite to start with. This is construction value put in place as tracked by the U.S. Census Bureau. And what it does is it does a great job of sort of helping you understand the magnitude of the development cycle that we're in right now, as well as the directionality. So this data goes back from to January of '93 through almost through the end of 2019 here. As you can see, we're in the midst of an unprecedented development cycle. The chart over on the right shows the annual growth rate, which has slowed in 2018 and has actually gone negative in 2019, which is indicating that we are sort of mid to late cycle. Things have started to peak and now slowing down slightly. So this next slide here are a summary of the number of deliveries in the macro market. You can see in 17 things picked up significantly from 16 and have stayed at an elevated about 1,000 facilities over the last 3 years. Sorry about that. Audio cut out. Still ironing out a few kinks here, but I'll just go back to the top of this slide. Florida markets have sort of dominated the activity in 2019. As you move towards the bottom of the list here, you see a lot of markets in California. Much higher barriers to entry in California, much later to the development cycle, so not as much activity there. On this next slide here, we have got, we're looking at the last 3 years, so the compounding deliveries, and we'll sort of get into a little bit more detail on why this is important, but essentially lease-up times are roughly 3 years, so facilities that have been delivered in 17 and 18 are still leasing up. They're still going to have an impact on the market, so it's very important to sort of look at rolling 3-year delivery growth rates. Again, a lot of Florida markets towards the top. Denver, Colorado, Raleigh, North Carolina have seen a ton. You've got Texas there towards the middle, so Texas wasn't a lot in 2019, but they were much earlier to the cycle, so they had a lot of activity 16, 17, and 18. So Texas markets there towards the middle. And then again, California down at the bottom. So that's what's going on with sort of the development activity. And this chart here is the cap rate index of the publicly traded REITs. I think this is actually one of the most important slides, although it's also the simplest. What the cap rate index represents is the exit rate or the exit valuation that developers expect when they start a new project. And as you can see, we're towards the lows there, around a 5% cap rate right now. And if we think about what has been driving this development cycle, it is their ability in 2014, 2015, 2016 to build at a 10% plus and sell at a 5 cap. That 500 basis points plus of margin is really what has been driving the development activity, which is what's really important to understand, why we're in this development cycle. As we move into 2020, development yields pro forma are certainly coming in. This is a bit of a generalization, obviously it differs from market to market, but 7.5%, 8% is what many of the pro formas look like now. So there is less of an incentive now to be building than there was 3-4 years ago, and therefore we do expect and are seeing that development activity starts to slow. That being said, there's still 250, 300 basis points of margin there is still enough for activity to continue, so we're not expecting a steep decline here. So that's a little bit of overview on sort of what the development activity so far and where we stand. I'll just pause there for a second, see if there's any questions here. Go to live stream. I do have a question here via email asking about what has driven those pro formas lower. So, Cor, if you don't mind going back to the previous slide. So historically, we're at 16, historically we're at 10% cap rate plus on the pro forma yields. Now it's 7.5%, 8%. The primary reason for those development yields to come down on a pro forma basis is definitely rental rates, and we'll get into a little bit of that here on the next slide. So rates and lease-up times have been putting pressure on that, and additionally, costs have been rising. So to a lesser extent, costs have been rising. Labor, material, et cetera, have also compressed those pro forma yields for developers. This slide here, we have a visualization of lease-up times for extra space storage facilities. We've got 4 different cohorts here. We think this data is generally representative of the market. We're only using extra space storage data because they give such detailed disclosures, but we do believe this is representative of the market. And as you can see, the trajectory in 18 and 19 for the first couple quarters after certificate of occupancy are leasing up much slower. 18 is clearly below 16 and 17, and 19 off to a lower trajectory. So we are seeing lease-up times extend as we move through this cycle. And here's just another slide sort of reiterating that point. The first chart is our estimates of sort of on a national basis what the estimated lease-up times are, and those have been extending. And then more importantly, the implications to the percentage of stock in lease-up at any given time. As lease-up times can extend and we move further through the development cycle, you have sort of a compounding effect where the percentage of stock continues to grow many years after. So this is very important as this is what's driving your supply-demand fundamentals. And then here we have the web rates. This is the national web rate, average price per square foot, January 17th through today. You can see there's a clear downtrend. The peaks and troughs, are obviously representative of the seasonality in the industry, but a clear downtrend over the last few years. Chart on the right will have the annual growth rates there, down roughly mid-single digit the last 2 years. 2020 starting off a little worse. However, just a few weeks of data here, so hard to read too much into that at this point. Here are some of here are the top 40 markets and the rate trajectory in those markets. Towards the bottom, again, markets that we have seen development activity in: Florida, Texas, Colorado, Raleigh, et cetera. California markets up towards the top, performing much better. if we move to the next slide here, we've got the 3-year price change. So just as we looked at, the compounding supply growth, what those rates have done over 3 years, and you'll see Denver rally, Houston towards the bottom, almost 30% in web rate decline over the last 3 years. So all the supply that has been coming online has had an impact on the market, and in turn, these rates, these changes in rates are going to flow through to future development activity, which we'll show you a little bit more on some upcoming slides. I think this is a great chart. Like, does supply growth matter? It most certainly does. On the y-axis, you have the 3-year compounded supply growth. On the x-axis, you have the rate change over 3 years, and you can see there's a clear correlation here. The more supply growth you have over a 3-year period, the greater the impact is on your web rate or your entrance rate. The one outlier that's clearly identified in this chart would be Phoenix, which has seen extensive supply growth. However, their rates have held up really well, and we'll show you on the next slide here. This is due to demand. So price is a function of supply and demand. We're not just looking at supply. We want to look at that in conjunction with demand. And we use employment growth as a proxy for self-storage demand. The short of it is, the greater the employment growth, the more migration you have within a market, and migrants are the ones that consume self-storage. I'll have Corey drop a paper in the chat right now if you want to dive in a little deeper into what our analysis on why employment growth is such a good proxy for demand. You can check out that paper. But as you see here, if Corey, you could go back, is that Phoenix has seen well above the national average employment growth, spiking nearly 5.5% there in 2018. So this employment growth helped their fundamentals. On a national level, we are seeing employment growth slow, which makes a lot of sense, just given how late we are in the overall macro cycle, not just the self-storage cycle. We're seeing employment growth slow, and do expect that continues to weigh slightly on demand growth for the self-storage sector. So those are the major implications from all the supply. Lease-up times and entrance rate or web rate are impacted by new supply. I'm going to pause there again to see if we've got any questions. I'll just go over here to Corey, see if he wants to read anything out here.
So Aaron's asking, have we done any comparisons of street rates to in-place rents against the percentage of supply growth to determine if the occupied square foot revenue is as impacted as the street rates have been? So essentially,
So I mean, there's a lot in that question. I don't know if everyone can just check out Aaron Swerdlin's question on the YouTube channel. But essentially, I think the short answer is certainly in-place rents and revenue at a given facility are not nearly as affected as web rates are to new supply. And the primary reason is new supply new entrants is a highly competitive market. So new supply is fighting for those new entrants. There's going to be a lot more competition there, and that's where you're going to see the impact. Your in-place rents or existing tenants is more like a monopoly market. Once you've got those tenants in the door, it's essentially like a monopoly. You can ask your friend to do anything for you in the world except help you move your house. So once you've stored stuff, it's very hard for people to move that out. And most of the data is still pointing to mid to high single-digit annual increases on existing tenants are there. So certainly Again, sorry about that, but I'm back. Any other questions here? Okay, so we will, looks like we're back here. We'll pivot now to our outlook for the self-storage market. Sort of going back to the first slide with the U.S. construction spend, we do expect that we're sort of through the peak at a national level, and things are starting to slow here. You'll see we're tracking 489 facilities under construction in the top 50 market. This is a great proxy for forward 12-month activity. It is a little underrepresented. We do expect that 525 to 625 are delivered, or 575, which is slightly slower growth in 2020. But looking out further into 2021, 22, we expect things to continue to slow. We're talking to a lot of developers on our platform every day, lenders, equity providers. Certainly, projects are getting harder to pencil. Those 10 caps that were found back in 2014, 2015 are certainly no longer. So things are starting to slow, and that should have a positive impact on those web rates or that entrance market going forward. So again, for 2020, we expect roughly 4% increase in stock for the top 50 markets. And if we go to the regional analysis, it paints a little bit of a different picture here. You'll see towards the top, we've got one Florida market, a little bit of Texas, but what's really taking up the real estate there would be the Northeast corridor. So we've got New York, Washington, Philly, Boston is in there as well. So we are seeing development activity shift from early markets in the cycle like Texas and Florida, now moving to the Northeast corridor. So if you go all the way to the bottom, you'll see rallies down there. Denver, not seeing much activity. As we discussed before, they've seen rental rates decline significantly. They've had a ton of supply, and clearly that is, affecting, having an effect on the market. Developers are slowing down there. So those are all natural signs of a cycle. And then furthermore, on this planning and permitted, if we look out even further, we continue to see, that Northeast corridor. A few markets in California, again, this because they're later in their cycle, starting to catch up. So there are few California markets are starting to move up the charts there. But essentially, the premise is, from a macro national level, we're sort of through that peak. We're starting to slow. We don't see a drastic fall off in the next year or two, but certainly we're through that peak. And then on a regional basis, that certainly depends. Many of the markets are already through the peak, and others are just starting to have more of a focus in the Northeast corridor and in those California markets to a lesser degree. So that's all we have from a prepared standpoint. Happy to take questions here on the self-storage fundamentals. You can drop them in the chat. FaceTime us, james@unionrealtime.com from your Apple device. We can take your call live. If there's no questions on the self-storage market, we're also happy to answer questions on any of our data. Where does it come from? Any of our products? Where can you access this data? Most everything you've seen here today is available in real time across our products. So happy to answer any of those questions. If there are no questions, please, we would love your feedback. Drop them in the comment section. That would be great. We're always trying to iterate, whether it's our product, our content. Your feedback is valuable. So
Francois, do you have any data on Canada?
we do not officially cover Canada. So not at this point. We are exploring adding that in sort of the medium term, but not a near term focus at this moment.
The only question I see. How negatively has the steel tariffs pricing affected costs?
Oh, that's a tough question. I'm not quite as up to date on this. We may have to get back to you a little bit on this, but I do know about 12.
Terry was saying earlier this week that it was an issue last year.
Yeah,
not as much.
I was going to say 12 to 18 months ago, it was more of an issue. Janice, who's the big door provider in the market, had a few letters that went out to clients raising rates due to steel costs. Not as much impact this year as last year, so that seems to have mitigated. I think labor costs are still elevated, but certainly not seeing the. There was a shortage there for a while, just in the macro cycle as well. So costs are definitely impacting things, but not nearly as much as the rates in the market. If you got any value out of it today, well, we're just hold on. If we're waiting on a few more questions, but if I can interrupt for a second, if you got any value out of our presentation today, please follow our YouTube channel. You can also just click that bell to get notifications. Jonathan's putting out a lot of great content, self-storage updates as well as fun and exciting content, including all the ping pong championships. You could also follow us on, Corey will drop this in the chat right now. You can follow our LinkedIn channel, Radius Plus, which we're doing a great job, but about to ramp that up to another level. So there's a lot of great information there if you are looking for more educational info.
Joel is asking what type of profit is a developer looking to get from cost to sale in this current market?
Well, from a cap rate standpoint, I can tell you typically 250 to 300 basis points is I mean, it differs from developer to developer. Corey can maybe add more color from
Yeah, that basis point difference just turns into whatever income that facility is making.
Essentially it. He says he's giving me the nod. Thank you for the question.
Let's see, what else do we have? We have
No FaceTime callers?
Warner asking, are you keeping up with the moratorium ordinance in Miami-Dade County? We saw that last week.
Probably not up to date as we should be given the question. I do know that Miami had an ordinance where you couldn't build a new one within like a mile. We're still seeing a lot of activity in Miami though, so I'm not sure if it is really having the impact that they thought, but
Projects are already kind of cemented in Miami-Dade.
a lot of projects are already cemented. This happened, some of these get planned well in advance, so they're already through the wicket, so to speak. But we'll have to update ourselves on the latest there.
That's all we got right now. Got another one. What do we got?
Go back to the second or third slide where it's showing oversupply for 2019.
Sure, Corey can take us back there.
Is this the one he's talking about?
If you've got any questions about the Radius platform or the data behind it, the data behind today's presentation or platform, please feel free to ask those as well. So Corey went back to the slide there. Our moratorium ordinance an issue in some markets? Well, I mean, think most self-storage participants welcome some slowing in development. Obviously, developers don't, but
We have a great article on that on our website that we can post to the page that talks about how moratoriums don't actually affect.
Corey will post an article right now. He'll drop that in the chat on our impact of moratoriums. All right, well, thank you very much for joining us. That's it. And again, please submit some feedback. We'd love to hear from you. Thank you.